Welcome to Educounting, where we're passionate about financial education. Today's video is on asset allocation and diversification. Sometimes asset allocation and diversification are used interchangeably. However, we need to be careful as the definitions can be a bit confusing. Asset allocation is the process of allocating a portfolio into the four different asset classes, including stocks, bonds, cash, and commodities. Stocks are considered more risky than bonds or cash, and generally return more over time. Cash is the least risky, but it also gives the smallest return. Asset allocation is the primary factor of risk in a portfolio. Risk, in this sense, is how much the portfolio will move up or down in value from one period to the next. Some portfolio values change very little over time, like a cash account, earning 3% interest, compared to a tech startup stock, which can swing wildly up and down over time. First, you must determine what your risk and return profile is. Can you sleep at night if the market goes down 20%? If not, you may not be able to handle risky investments. If you don't need to earn a lot on your investments, you may not care if you get big returns. Based on this feedback, your risk is lower, as well as your expected return. This generally means less stocks and more bonds, which could equate to an allocation of 20% to stocks and 80% to bonds. This definitely creates diversification, but within stocks and bonds, you have other choices. Allocating the entire 20% of stock to one company is not a good idea for risk. For stocks, you can diversify into many different categories like large cap, mid cap growth, value, and the same is true with bonds. They can be put into government, investment grade, high quality, and other. The key is to realize asset allocation and diversification work together and are key aspects for reducing risk in a portfolio. Thanks for being here. Here's to making better decisions through better data and better education.